This video was made in the beginning of this month, July 2024, knowing that I'd be traveling on Friday, July 12th, 2024, the day of its release. We're going to forego 1 week of bullion market update minutia to take a gander at the longer-term trends in relation to gold's future long-term price targets. We've done 6 videos related to this subject prior, and they will all be backlinked in the show notes below, along with a public Google Doc spreadsheet documenting the ongoing data and source links for each representative video present and past. When we began making these particular types of updates in the summer of 2020, the hard US debt at the time was $25 trillion. It has since ballooned to now almost $35 trillion outstanding, a gigantic growth of 40% more US debt outstanding in just the last 4 years. Continue on this trend, and the outstanding US debt will be $50 trillion by the summer of 2028. This video's long-term gold price target data is based on historical US financial history precedents and past, where the US official gold reserve value accounted for 40% of the outstanding physical US dollars in domestic circulation at the time. This happened on 3 different occasions in the 20th century, and given building evidence of a global return towards gold bullion as a financial foundation this 21st century, producing another 40% coverage rhyme in its time is the thesis of this coming gold price projection video. This said, the main long-term fiat US dollar gold price target I will cite will be conservative in size. Normies who are watching are probably unaware of systemic gold and silver price suppression in the West running for decades now since the old 1980 high. They should be able to wrap their minds around the coming price projections, at least the conservative ones. Government central banks are front-running this return to gold at the moment. In the last 3 years, central banks have admitted to buying more official gold bullion in sizes and volumes never before seen on record, to the tune of about 1,000 metric tons of gold bullion bought annually in 2022, 2023, and forecasted for this year, 2024, respectively. 1,000 metric tons is equivalent to nearly a third of newly mined gold globally per year. This rabid gold buying by central banks is occurring simultaneously as over 130 countries and currency unions, representing 98% of global GDP, are also exploring formations of government-issued CBDCs or central bank digital currency programs. Simultaneously, private digital tokens such as Bitcoin, the supposed digital gold as many have marketed it to be, is still priced around 60,000 fiat US dollars per unit. Its existence has surely helped pave the way psychologically and build a better collective hive mind understanding of how overrun the world has become with risk-laden fiat currency supplies. But alas, the market capitalization that appears poised to swap its overall size with bonds increasingly looks like gold bullion officially held in reserve. Since COVID 2020, the secular bear market in US bonds appears to have kicked off. Poorly performing long-term US bonds have been increasingly bypassed by international buyers, while central banks, many who used to buy US treasuries offshore, are often instead net buying gold in record size. Now, Judy Shelton, an American economic advisor to former President Donald Trump, is publicly making the case for the US bond market to return back towards physical gold underlying its credibility, even suggesting that the US Treasury could officially revalue its official gold reserves markedly higher to build back faith in our future bond auctions.
What I'm proposing in the book is to set up a barometer. Set up a barometer so people can see, what if we really did have sound money? What would be the difference between a treasury instrument that paid off in gold at the option of the bondholder compared to a traditional treasury certificate? Well, what about 50 years from now? Would you rather have 2,400 US dollars or an ounce of gold? Obviously the gold, because they know the dollar deteriorates. So we start with that. Good as gold. Here's what I'm suggesting in the book. It would be a bold proposal under a president who sees the imperative of setting up a marker in favor of sound money. The U.S., since 1973, has been carrying 261 million ounces of gold at a price of $42.
In the Financial Accounting Manual for Federal Reserve Banks, we can see the mechanism the U.S. Treasury may eventually use to make the U.S. fiscal situation balance better than it is at the moment, likely marking up the gold price of U.S. official gold reserves from the long-held depressed $42.22 an ounce price level set in 1973 to a price level substantially higher, perhaps during a crisis in market confidence to come. Here's Luke Groman's take on how drastically higher U.S. gold prices on the books will have to be marked up to bring back confidence and simply match past historical precedents.
What is your take on Judy Shelton's suggestion of U.S. Treasury gold bonds for the long end? In my opinion, her suggestion makes perfect sense, essentially creating long-term bonds that would have some sort of gold convertibility to them in whole or in part. Ultimately, given the debt levels, it would require in all likelihood a much higher dollar price of gold. And so it would amount to a dollar devaluation of sorts. It would go back ultimately when you think about valuation of gold relative to the dollar. It would go back to my point about or metric of U.S. official gold at market price as a percentage of foreign held treasury bonds outstanding. We've highlighted that percentage is currently around 7%, that in 1989 it was around 20%, long-term average was around 40%.
Notice a historical 40% coverage figure precedent also applies to the offshore U.S. bond market values versus official gold reserves.
And in an honest-to-goodness dollar crisis, it was about 135% in 1980. So we would need likely at least up 3x in terms of the implied gold valuation, maybe as much as 6x to get back to the long-term average, and of course 19x in an honest-to-goodness dollar crisis. So bottom line is it makes a lot of sense. It would make long-term bonds very attractive by essentially ending the risk of long-term inflation, and as such would serve to reduce long-term borrowing rates for the U.S. government.
The largest collective official gold reserve holding in the world is the European Union. And many European central bankers, particularly in the Netherlands and Germany, openly infer their gold valuation accounts as a way to recapitalize their central bank balance sheets without selling any of their gold or asking taxpayers for funds long term. Given where the fiat euro M2 supply is at the moment versus the ongoing fiat euro gold price per ounce, we'd need to see the spot price in Europe multiple 6 times at the moment versus the size it's at now to reach levels not seen since the peak of the last Western world gold bullion bull market in the beginning of 1980. Stick around. Long-term fiat US dollar gold and silver price projections are coming up next. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a Monster Box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
All fiat currencies by design lose value to gold bullion over time. The question we're tackling here is the coming final loss of fiat currencies to gold and how drastic nominal price highs might climb. The fiat US dollar since 1970 has already lost over negative 98.5% of its value to gold bullion. We're looking out at the final negative 1.5% loss and what it means for long-term bullion holders to come. Well, since the start of 1970, the gold spot price has run from $35 an ounce to now over $2,300 an ounce. That's more than 67-fold. To repeat something akin by the year 2078, for instance, the fiat US dollar gold price would have to be nearly $160,000 an ounce. It's unlikely the current unipolar dominant US dollar reserve currency post-Bretton Woods system lasts in the coming decades. The changes coming along will probably be very quickly given the technology applied. And in those changes, it's very likely the spot US dollar gold price will revalue sharply higher and faster than perhaps it's ever done prior. Since the start of 1970, the spot silver price has run from $1.80 an ounce to a still ancient nominal high of $50 and back down to where silver's building its current bull market of today, with spot priced at the moment near $30 an ounce. The spot gold silver ratio is still around a historically high level of 77, with the longer term target in a bullion bull market mania aimed at eventually again falling below the low 30s to levels last seen during the early 2011 silver price run to 50 an ounce and during the 1970s and the 20s. Silver bullion bulls like myself are making a long-term bet that silver's relative value versus gold this decade into next will tighten, and for some duration, silver will vastly outperform gold as it did in the late 70s and early 2010s. Ignoring the coming long-term fiat currency gold and silver price target levels for just a moment, in the real world, what we're talking about is both gold and silver respectively buying way more in terms of other asset classes like US stocks or median real estate as the bullion bull market goes into a blow-off euphoria phase future. There remains a current very real possibility of gold bullion owners today eventually being able to buy 10 times more S&P 500 US stocks than they do at the moment. A similar potential for silver bullion owners being able to buy way more of the S&P 500 in the eventual rollover of this long-term chart, going back beyond the 2011 lows and perhaps back towards the levels last seen during the 1970s. Finally, we move to the long-term gold and silver price targets for 40% coverage of U.S. official gold reserves versus outstanding unbacked fiat U.S. dollar supplies outstanding. This data is only measuring the domestic USA fiat US dollar currency supply and circulation data. The fiat monetary base is simply counting the hard US dollar cash notes outstanding within the US domestic economy. Now, the amount of fiat US dollars being held offshore dwarf the domestic fiat US dollar supplies. After all, the fiat US dollar is our most successful export by far and away. Just to merely see history rhyme in the domestic United States, where this has already occurred 3 other times last century during structural resets and crises in fiat currency confidence, we at the moment need to see the spot gold price at $8,758 an ounce to cover 40% of the fiat US dollar monetary base printed and outstanding. If the spot gold silver ratio were at 30 during such a rampant move in spot gold, we're talking about a spot silver price of nearly $300 an ounce. But we all know that most so-called money or fiat US dollars in circulation today are digital in formation, sitting in demand deposits or checking accounts at banks and other financial institutions. And since COVID 2020, the fiat US dollar M1 supply has also counted savings deposits, including money market deposit accounts, as part of the domestic fiat US dollar M1 supply count. Well, to get the spot gold price back toward its last bullion bull market level of nearly 1-to-1 on the bottom half of this chart, the spot gold price would nearly need to eightfold from here without the fiat M1 supply growing further. In order for the U.S. gold reserves to be valued at 40% of current outstanding domestic fiat US dollar M1 supplies, we'd need more than a zero added to the current spot gold price, and the spot silver price at a 30 GSR level would be threatening 4 figures in such a drastic scenario. The bottom line in all this is that a crisis in confidence globally is coming to both the sovereign bond and fiat currency markets, and it will come in waves and cycles. In those coming waves, bullion is poised to rise substantially higher in value and nominal prices around the world, the former being the most important to long-term holders of physical gold and silver respectively. Gold and silver are poised to rise in purchasing power in relatively all asset classes and goods and services throughout the world over time. Take advantage while you can acquire a prudent position in bullion like central banks are collectively doing in record size at the moment, simply knowing the long-term trend will be our net worth friend over time. That's going to be all for this week's SD Bullion Market Update. I'll be back next week with real-time updates. Until then, as always, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.